63 million Americans are about to discover that the retirement they were promised does not exist in the form they were promised it. Not because someone stole the money, not because of fraud or malfeasance or the kind of dramatic criminal conspiracy that generates congressional hearings and prosecutorial press conferences, because of mathematics, because of the specific documented, actuarially confirmed mathematical reality that the pension funds managing the retirement security of 63 million American teachers, firefighters, police officers, government workers, and private sector employees are carrying a $2.1 trillion funding gap between what they have promised to pay and what they actually have the assets to deliver. $2.1 trillion, not a projection, not a stress test scenario. The current, confirmed, officially reported aggregate unfunded liability of American defined benefit pension funds, the gap that exists right now in the current investment environment, at current asset valuations, before the commercial real estate write-downs that have not yet been marked, before the private equity portfolio revaluations that have not yet been forced by market transactions, before the alternative asset illiquidity discounts that have not yet been applied because applying them would require acknowledging a funding crisis, that the institutions managing these funds have powerful institutional incentives to defer acknowledging for as long as the regulatory framework permits. The $2.1 trillion is the official number. The real number is larger, significantly larger, and the gap between the official number and the real number is the specific, financially consequential, retirement-destroying gap that this video is about. Not the gap between assets and liabilities. That gap is officially acknowledged, officially reported, officially described as manageable through investment returns and contribution adjustments that the official models project with the specific, optimistic, institutionally motivated assumptions that have been systematically overstating pension fund health for 3 decades. The gap between the official number and the real number is the gap between what pension funds report their assets are worth and what those assets would actually sell for in the current market. Mark-to-market reckoning that has been deferred, avoided, and structurally prevented from appearing in official pension fund financial statements by the same combination of accounting flexibility, regulatory forbearance, and institutional incentive that has been deferring the commercial real estate reckoning in the banking system for the past 3 years. The time bomb is ticking. The clock is visible to anyone reading the underlying data, and the 63 million Americans whose retirement security depends on diffusing it are the last people in the financial system to be told that it exists. Let's establish the specific mechanics of the $2.1 trillion pension funding gap with the actuarial precision that its retirement consequences demand. Because the mechanics are not complicated, they have been made to appear complicated by the institutional apparatus that benefits from the complexity, the actuarial consultants, the investment managers, the accounting firms, and the regulatory bodies that have collectively constructed a reporting framework designed to maximize the period during which pension fund stress can remain officially unacknowledged. Strip away the complexity and the mechanics reduced to 3 numbers and 1 assumption. The 3 numbers are the present value of promised future benefits, what the pension fund has committed to paying retirees over their lifetimes, discounted to today's dollars, the current value of the assets held to fund those benefits, and the gap between the two. The 1 assumption is the discount rate, the assumed annual investment return that determines how much today's assets will grow to fund tomorrow's promised benefits. Change the discount rate, and you change the reported funding status of every pension fund in America simultaneously without touching a single actual asset or changing a single actual liability. American public pension funds, the funds covering state and local government employees, use an average assumed rate of return of approximately 7% to discount their future liabilities. This 7% assumption is the specific, critical, institutionally defended number that is doing most of the work in making the $2.1 trillion official unfunded liability appear manageable rather than catastrophic. At 7% assumed returns, the pension fund needs a certain amount of assets today to fund its future obligations. At 4% assumed returns, closer to what long-term Treasury bonds currently yield, the risk-free rate that actuaries have historically used for pension liability discounting in countries with more conservative accounting frameworks, the same pension fund needs dramatically more assets to fund the same obligations. The difference between a 7% discount rate and a 4% discount rate applied to $5 trillion in public pension assets produces an additional $1.50 to $2 trillion in reported unfunded liabilities that do not appear in the official $2.1 trillion figure because the official figure uses the 7% assumption. The 7% assumed return is not just aggressive. It is a specific, documented, independently criticized number that the pension fund management industry has defended with the specific institutional ferocity of people whose compensation, whose institutional survival, and whose professional reputation depend on maintaining an assumption that allows the funds they manage to appear adequately funded. The American Academy of Actuaries has issued formal guidance recommending more conservative discount rate assumptions for public pension funds. The Government Accountability Office has published reports documenting the sensitivity of public pension funded status to discount rate assumptions. Academic researchers have published extensively on the gap between the 7% assumption and the returns that pension funds can realistically expect to achieve in the current investment environment. None of it has changed the industry standard. Because the industry standard is not a technical actuarial judgment. It is a political outcome, the result of pension fund trustees, public employee unions, and municipal governments collectively determining that the contribution increases that honest accounting would require are politically unacceptable, and therefore the accounting must be adjusted until it produces a politically acceptable result. The private equity exposure is the hidden financial nuke inside the pension fund. Time bomb. American public pension funds have allocated approximately $1.2 trillion to private equity, an asset class whose defining characteristic is the absence of mark-to-market pricing. Private equity investments are carried at valuations determined by the general partners managing those investments, valuations that are updated quarterly based on comparable transaction multiple and discounted cash flow models rather than actual market transactions. During the 2021 peak of the private equity boom, comparable transaction multiples were at historic highs, and discounted cash flow models used interest rate assumptions that reflected the near-zero rate environment of that era. In the current environment, where comparable transaction multiples have declined 30 to 40% from 2021 peaks, and where discount rates have increased by 500 basis points, the private equity portfolios that pension funds are carrying at 2021 adjacent valuations would sell for dramatically less than their reported value if they were actually liquidated in the current market. The transaction volume collapse in private equity buyout deal volume fell 60% in 2023 from 2021 levels, means that the mark-to-market reckoning has been deferred by the absence of transaction. That would force valuation updates. Private equity managers are not selling assets at current market prices because current market prices would reveal losses that their carried interest arrangements and fund performance metrics make financially catastrophic for them to acknowledge, so they hold. And as long as they hold, the pension funds holding their fund interests carry the positions at stale valuations that overstate current market value by an estimated 20 to 35% across the asset class. Applied to $1.2 trillion in pension fund private equity exposure, a 25% average overstatement represents $300 billion in phantom assets that appear on pension fund balance sheets but would not survive actual market liquidation at current prices. Add the private equity valuation gap to the discount rate adjustment, and the official $2.1 trillion unfunded liability becomes something closer to $3.50 to $4 trillion in actual economic terms. That is the real time bomb, not the manageable $2.1 trillion that official reporting presents as addressable through gradual contribution increases and optimistic return assumptions. The $3.50 to $4 trillion that mark-to-market accounting and honest discount rate assumptions would reveal representing a funding crisis of sufficient magnitude to require either massive contribution increases from state and local governments that are already fiscally stressed, benefit cuts for current and future retirees that are politically catastrophic, federal bailout of a scale that the $34 trillion national debt cannot absorb without triggering the sovereign debt crisis. It is designed to prevent, or some combination of all three that distributes the pain across taxpayers, retirees, and future generations in ways that no current political system is structured to honestly acknowledge, let alone manage. The pattern of pension fund underfunding disguised by optimistic actuarial assumptions, deferred by accounting flexibility, and ultimately resolved through some combination of benefit reduction, taxpayer bailout that was never officially acknowledged as a possibility until it became an operational necessity, is one of the most precisely documented patterns in the history of public finance. It has appeared in every major developed economy that adopted defined benefit public pension systems with democratic political systems. The combination that structurally guarantees benefit, promises will be made beyond the fiscal capacity to honor them, because the politicians making the promises face the election before the bill arrives, and the generation paying the bill votes after the politicians who created it have retired. Study the Detroit municipal bankruptcy of 2013 with specific attention to the pension fund component, rather than the broader narrative of urban economic decline that typically frames the historical account. Detroit's bankruptcy, the largest municipal bankruptcy in American history at the time, was not primarily caused by the decline of the auto industry or the depopulation of the city. It was caused by the specific actuarially predictable, institutionally avoided mathematical reality that Detroit's pension funds had been making promises for decades that the city's shrinking tax base could not fund at the contribution rates that the optimistic actuarial assumptions made appear sufficient. The pension funds reported adequate funding using 8% assumed return assumptions. Independent analysis using more conservative discount rates showed funding ratios below 60%. The gap between the reported position and the actual position was not discovered in the bankruptcy. It was acknowledged in the bankruptcy after decades of official reassurance that the situation was manageable, had prevented the political will to address it while addressing it was still possible, at reasonable cost. Detroit retirees received benefit cuts of 4.5% for general retirees and the elimination of cost of living adjustments that represented a much larger real benefit reduction over time. The people who paid the price were not the actuaries who used optimistic assumptions, not the politicians who made the promises, not the investment managers who collected fees on the assets while they declined in real value. The retirees, who had organized their entire retirement expectation around promises that the political system made without the fiscal capacity to honor, and that the institutional framework was specifically designed to prevent from being honestly evaluated until it was too late to address them at reasonable cost. The hidden financial force that makes the Detroit pattern not an isolated municipal failure but a systemic national pattern is the interaction between the political economy of public pension promises and the accounting flexibility that allows those promises to be made without immediate fiscal consequence. A politician who promises enhanced pension benefits to public employees in exchange for electoral support generates an immediate political benefit: union endorsements, campaign contributions, organized voter mobilization, while deferring the fiscal cost to future politicians, future taxpayers, and future retirees who will bear the consequences of the promise when the mathematical reality, it was always inconsistent with, eventually asserts itself. This incentive structure does not produce occasional bad actors who make irresponsible promises. It produces a systematic tendency across every political system with defined benefit public pensions to make promises that exceed the fiscal capacity to honor them because the political rewards for making the promises are immediate and certain, while the fiscal consequences are deferred and distributed across constituencies that do not yet exist at the moment the promise is made. The Illinois pension system is the national-scale version of the Detroit dynamic currently in progress. Illinois' 5 major pension funds carry an officially reported unfunded liability of approximately $200 billion, the largest state pension funding gap in America. The funded ratio of the largest fund, the Teachers' Retirement System, is approximately 40%, meaning it has 40 cents of assets for every dollar of promised benefits. Illinois has been making its actuarially required contributions for years without materially improving the funded status, because the assumed 7% return assumption has not been achieved consistently, because the benefit structure was designed when returns on safe assets were higher, and because the compounding of the existing unfunded liability at assumed return rates exceeds the contribution capacity of the state's fiscal position. Illinois is not on a path to pension solvency. It is on a path to the choice that Detroit made in 2013 between benefit cuts, tax increases of a magnitude that would accelerate population and business emigration, and federal bailout of a scale that sets the precedent for every other underfunded state system simultaneously. Watch 4 developments in the next 24 months that will determine whether the $2.1 trillion pension time bomb is diffused through painful but manageable policy adjustment, or detonates through the forced reckoning that deferral always produces at compounding cost. First, watch the private equity secondary market transaction volume for any acceleration in pension fund portfolio liquidations. When pension funds begin selling private equity interests in the secondary market, accepting the 20 to 30% discount to stated NAV that the secondary market currently prices, it signals that liquidity needs have overcome the institutional incentive to maintain stale valuations. Secondary market liquidation at discount prices forces the valuation write-downs that update reported funded status and reveal the gap between official and actual funding levels. Second, watch state legislature pension reform proposals in Illinois, California, New Jersey, and Kentucky, the 4 states with the most severely underfunded public pension systems. When reform proposals that include benefit reductions for current employees or retirees advance beyond committee, overcoming the legal and political barriers that have previously blocked reform in these states, it signals that the fiscal pressure has exceeded the political capacity to absorb it through contribution increases and return assumption maintenance alone. Benefit reduction proposals advancing in these states will face legal challenges under state constitutional provisions protecting public pension benefits. The outcome of those challenges will determine the resolution pathway for the national pattern. Third, watch the Pension Benefit Guaranty Corporation's financial position in its annual report. The PBGC is the federal insurance program that backstops private sector defined benefit pensions, the pension equivalent of the FDIC for corporate pension plans. The PBGC's multi-employer program, covering the pension funds of workers in industries with multiple employers like trucking, construction, and retail, was technically insolvent before the American Rescue Plan provided $86 billion in emergency funding in 2021. That funding bought approximately 30 years of solvency under the optimistic projections used to justify it. If PBGC multi-employer program financial position deteriorates faster than the 2021 projections driven by faster than expected plan insolvencies or investment return shortfalls, it signals that the federal backstop itself is approaching the capacity limit that would require either additional federal funding or explicit acknowledgement that the backstop guarantee is not unconditional. Fourth, and most critically, watch the actuarial assumption changes at major public pension funds. When a major fund, California's CalPERS, New York's Common Retirement Fund, Texas Teachers, announces a reduction in its assumed rate of return from 7% towards 6% or below, It signals that the actuarial assumption that has been doing the work of making the funding gap appear manageable is being adjusted toward reality. Each 0.5 percentage point reduction in the assumed return rate increases reported unfunded liabilities by approximately $300 to $400 billion across the national public pension system. The funds that make this adjustment first are acknowledging the mathematical reality that every fund faces, but that institutional incentives have made it rational to defer acknowledging for as long as the regulatory framework permits. Here is the final truth, that the $2.1 trillion pension time bomb demands be stated, with the generational clarity that 63 million people's retirement security deserves. The retirement promises were real when they were made. The people who received them worked their careers expecting to receive them. The teachers who spent 30 years in classrooms, the firefighters who spent careers running toward danger, the police officers who spent decades serving communities were not naive or irresponsible for believing that the promises made to them by their employers, their unions, and their governments would be honored. They were betrayed, not by dramatic fraud, but by the slow, systematic, institutionally rationalized process by which a political and financial system made promises it lacked the fiscal discipline to fund honestly, and then constructed an accounting and regulatory framework specifically designed to prevent the gap from becoming visible until it was too late to address it without someone absorbing catastrophic loss. The question that the $2.1 trillion time bomb forces every American to answer, not theoretically, but practically, in the specific financial decisions that determine whether their own retirement is secure, is whether they are among the 63 million people whose retirement security depends on a promise backed by a mathematical reality that is not what the official reporting suggests. And if the answer is yes, the framework for understanding what that means and what to do about it is available in the data right now, not in the official reports, in the actuarial assumptions, in the private equity secondary market discounts, in the Illinois funded ratio, in the PBGC multi-employer program trajectory, in every piece of data that the institutional framework was designed to make difficult to find and impossible to connect into the coherent picture it actually forms. The bomb is ticking, the timer is in the data, and the 63 million people sitting closest to it deserve to know how to read it.